So let me look at three main drivers of the gold price, three things that would indicate that the price of gold is going a lot higher and getting to the $10,000 an ounce I described. The first one is technical. So we're in the third great gold bull market in history. And you say, well, it isn't history. It goes back, five 7,000 years. How come it's only the third bull market? Well, the answer is that until 1971, gold was just money. You didn't have to say, what's the ratio or what's the price. It was a form of money. The IMF took subscriptions in gold. Gold was in the reserve positions of major central banks. So it wasn't until 1971 when President Nixon broke the last link between gold and I'll call it paper money or fiat currency, that the price of gold could fluctuate enough that you could have a so-called bull and bear market. So I start from 1971. So we had a bull market 9 years, from 1971 to 1980. Gold went from $35 an ounce to $800 an ounce. That was a 2,100% gain in 9 years. Then it was flattish, trending down for a very long period of time, almost 20 years in the 80s and 90s. Finally hit bottom at $250 an ounce in 1999. That's when the second great bull market began. And from 1999 to 2011, gold went from $250 an ounce to $1,900 per ounce. That's a 670% increase over 12 years. Then a very sharp bear market from 2011 to 2015. The price of gold collapsed over 50%, just about 50% for a round number. And then you can pick the exact day. I'll tell you the day, December 16th, 2015. That was the bottom of the bear market and the beginning of the third great bull market. And we're in that bull market today. The price of gold, it peaked, interim peak recently, August 8th, 2020. It hit $2,060 an ounce. That was more than double, just about double from the end of the last bear market, the beginning of the new bull market. It's backed off a little bit since then, about down around $1,800 an ounce, give or take. Obviously, a lot of volatility, but that's normal volatility and fluctuation in an extended bull market, which is what we're seeing right now, where the price of gold has doubled. But where is that going to go? So what I did, if you take those numbers, first bull market, 9 years, 2,100%. Second bull market, 12 years, 670%. Just take a simple average of the two. You don't have to pick the higher of the two. You don't have to assume it'll be bigger or longer. It could be, by the way, but just take a simple average of the two. That would come to a 10-year bull market where gold goes up 1,385%. So that would put gold at $14,500 an ounce in 2025.
Gold tends to go up when they print money because the assumption, which rightfully normally would be, you print a lot of money and it's going to, and especially if it goes into consumer and business spending, it's going to cause inflation. But remember, it's not going into consumer spending. Everybody's spent out, or only the wealthy are spending more. And they happen to be, the top 20% happen to be 50% of spending. That's the only reason we're growing. 4% growth in the up end, and on the bottom 80%, zero growth. But it's financial assets. But gold went up, especially with the money printing after late 2008. And then when Japan tripled down on money and the inflation kept falling, gold finally fell into late 2015. And it's rising again because money printing is stepping up. But again, I keep saying, where's the inflation? I've been saying literally out in public, it'd be impossible to create high inflation and really impossible to create hyperinflation in this global and US deflationary environment. So again, what's really happened, what really correlates with money printing is financial assets go up. Stocks, bonds, real estate, those sort of things, and especially stocks, because stocks are the highest return and benefit the most.
What's amazing about gold is that with deflationary headwinds, which we have had, gold has still gone up, almost doubled in the last 6 years, and it's held up very well. It gets knocked down every now and then, but if you had the kind of impact Harry's talking about, why isn't gold at $1,000 already, or even lower? So I'm impressed with the performance of gold in a deflationary environment, which we have had. But we're right at that inflection point. We're right at the point where it tips into inflation and accelerating inflation beginning in 2022 and thereafter. So the way to reconcile that, you have very short term, meaning a year or less, more disinflation, borderline deflation, but that's going to turn very quickly. So that's how I reconcile that. And by the way, just to be clear, I agree with Harry that we have come through enormous deflationary trends. I mean, that's absolutely correct. For the reasons I mentioned, which were the cheap Chinese labor, hundreds of millions of people coming off the farm, going into Lego-style assembly, and other factors, and then all the money printing. The reason the money printing didn't produce inflation was because it was just holding its own against the deflationary trends, which were demographic and globalization and automation and a number of other factors.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
You're admitting money printing doesn't cause inflation. Well, tell that to the people buying gold, because the people buying gold were following the money printing, saying it's going to cause inflation, and gold went from 1934 to 1050 in several months, from late 2008 into 15 into 15. I'm sorry, into 15, late 2015, because there was no inflation. So tell people that people are expecting that. I agree with you. It doesn't cause it unless the money goes into spending and business and consumer spending. It will not cause inflation. You're saying it doesn't cause it. You say inflate the currency. There is no choice to inflate the currency. Deflation is the only way to take out this unproductive assets. And by the way, Jim, you're wrong about workforce growth. That is my inflation indicator. I invented it in 1989. It's worked like a charm.
I said the central banks can't do it, but I also said there are other factors, psychological factors, behavioral adaptive behavior factors that will cause the inflation. I've said it 3 times. I'll say it a 4th time. Take notes, which is that when the labor force declines, wages go up. That's inflationary.
Not when it's a depression, not when it's because of a down economy. Yes, long term that could happen, but not in a crisis.
It's starting now.
This is important to understand. We've already been in this depression phase. They've been fighting it with money printing. I'm saying the depression is going to be over in 2 to 3 years. I say I agree. Gold will come out of this strong, and gold will boom for a long time into the next 30-year cycle, into the whole growth of Asia. So I'm just saying the next 2 to 3 years is going to be the backside 29 to 32 instead of the front side. We already had the front side GFC, like the 37, 38. That's the difference. This thing's going to be over. The demographics get better after that in a lot of countries, and gold will be a huge beneficiary of clearing out this debt and growing again, especially because Asia is going to be the big growth area, and Asians love gold.
No, it sounds far-fetched, but it isn't really, because again, I like to stick to 6th grade math. Here's what people don't understand. So let's just take 2000 for a round number. I know it's 1800, and I know that's a little bit away, but just take 2000 for a round number. To get from $2,000 an ounce to $3,000 an ounce is a 50% increase. That's a big jump. That's a high hurdle. But to get from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. That's like 1 week's volatility. What people miss is they focus on the $1,000 an ounce. And yeah, that's a big deal. If you have an ounce of gold or 100 ounces of gold or whatever, if you have an ounce of gold and it goes up $1,000 an ounce, you made $1,000. So that's real money. Good for you. But the point is, as you get to progressively higher levels, the same dollar increase is a smaller percentage increase because the denominator is larger.
It's impossible to create high inflation. The demographics and high debt all argue for low inflation to deflation in the years ahead. I don't see how you create enough inflation to get gold to 12 to 15,000. Now, what I would see is possible, what Jim said, if the collapse was severe enough, which I do see, by the way, obviously, is that if people say, well, wait a minute, we got to have some standard here, and it ain't going to be Bitcoin. Maybe 10, 20 years, it ain't going to be Bitcoin, okay? It's the most volatile asset on earth. And by the way, gold's almost as volatile as stock, so it's not a stable asset in these days either. But if they came to the conclusion, we got to have a standard for now, and gold became it, then that would be the case for gold going up for some period of time. But that's going to come at the end of the crash. I'm trying to protect people here. I'm just being really honest. For the next 2 to 3 years, what I call the crash of a lifetime, on a 90-year cycle that's the most potent, you got to get through this, preserve your assets. And if you're in deflation-friendly investments like long-term treasuries, stuff, you can make money to have more money to invest at bargain prices in the best places, and it will.
Harry and I agree on a lot of things. The one thing we don't agree on is the one thing where all the science, history, and mathematics support me, which is that when you have a reduced workforce, you get higher wages, and that's inflationary, and that's going to drive the price of gold much higher.